Welcome to our in-depth look at the Greater Vancouver real estate market as we navigate the complexities of 2026. If you've been feeling a shift, a profound change in the market's heartbeat, you're not alone. What we're witnessing isn't just another temporary dip or a seasonal slowdown. This is a new reality taking hold, a new normal that even the often optimistic Greater Vancouver Real Estate Board is acknowledging. The rules of engagement for both buyers and sellers have fundamentally changed, and understanding these shifts is absolutely critical right now. Stay with us as we unpack the crucial statistics, explore the underlying pressures, and reveal what you truly need to know to make informed decisions in this unprecedented market. Let's dive straight into the most recent data for January 2026. And the picture that emerges is stark. Sales volumes across Greater Vancouver absolutely cratered, marking a significant and concerning trend. We saw only 1,104 sales, a dramatic 28% to 29% lower than January 2025. To put that into perspective, last year was already coming off the lowest amount of sales in 25 years, and 2026 has started even slower. This incredible slowdown means we are currently sitting 31% below the 10-year seasonal average for sales volumes. January 2026 now ranks as the second weakest January for sales in the last decade, with only January 2023 seeing worse figures. Historically, last month was the third slowest January ever recorded, only surpassed by 2023 and the infamous GFC period of 2009. These are not minor fluctuations. These are monumental decreases, indicating a severe lack of liquidity and health in our marketplace. If this trend were to continue, it would undoubtedly have catastrophic implications for the entire real estate industry and all the connected sectors that rely on market movement. Now, let's turn our attention to inventory and new listings, because this is where the plot thickens considerably. The number of new listings in January 2026 reached around 5,150 to 5,161. While a 278% increase month over month might seem dramatic, it's actually fairly normal for January as properties taken off the market for the holidays are relisted. However, the critical takeaway here is that new listings were still 7% lower year over year, but a significant 19% above the 10-year average. What this means is that despite fewer new listings compared to last year's slightly more optimistic January, the total active inventory on the market is soaring. We ended January 2026 with over 12,200 to 12,500 total active listings. This figure is up 10% from a year ago and a notable 38% above the 10-year seasonal average in active listings. In fact, January 2026 saw inventory at a staggering 16-year high. This unprecedented level of supply, especially when contrasted with the dismal sales figures, creates a profound imbalance. If sales were to continue at their current pace, we are looking at approximately 11 months of inventory, meaning it would take nearly a year to sell off all existing properties if no new ones came to market. This is a historically high number, signaling immense downward pressure on prices due to the fundamental laws of supply and demand. The temperature of the market is further revealed by the sales to active ratio, a key indicator of market health. In January 2026, this ratio hit a startling 9% overall, the lowest reading recorded in the last 13 years and the first time it's been this low in my career. Breaking it down, detached homes are at a mere 6%, townhomes at 11%, and apartments at 10%. All these figures are well below what is considered a healthy market, typically 12 to 20%. This statistic is not merely cyclical noise, it represents deep structural pressure and change. When every property type is below healthy levels, there is no rotation or relief coming from other segments of the market. In a 9% market, the question for sellers isn't what is my home worth, but rather, why would a buyer choose my home over the dozens they are currently ignoring? And why now? This heavily favors buyers, yet paradoxically, buyers are not out there buying, leading to a market that seems to be collapsing within itself. This extreme imbalance is also impacting the time properties spend on the market. Days on market for a properly priced property is now 38 days, up from last month and a 7-year high, dating back to January 2019. These 7-year, 13-year, and 16-year highs are extreme and indicative of a once-in-a-lifetime market situation. All these factors culminate in the critical metric prices. For the 10th consecutive month, the Home Price Index HPI has dropped, falling 1.2% month over month in January 2026. This is a significant monthly decline. If extrapolated annually, it would represent over a 14% decrease. Year over year, home prices are now down 5.7%, currently sitting at approximately $1,171,900. Since the recent cycle high in March 2025, prices have fallen by $84,000 or 7.5%. What's particularly striking is that home prices today are effectively back to September 2021 levels, marking a 4.5-year low. Delving deeper into property types, detached housing prices have taken a substantial hit, dropping almost $150,000 from 2025 levels, bringing them back to 2021 and 2022 ranges. Townhouses have seen a nearly $100,000 drop, returning to 2022 levels. Condos, however, present a particularly concerning trend. While they've dropped about $45,000 from January 2025, their benchmark price has remained relatively flat since 2018. When accounting for inflation and carrying costs over an 8 to 10-year period, many condo owners are effectively treading water, challenging the long-held theory that you're guaranteed to make money by holding property for a decade. The message from the real estate board itself is candid. They are not sure how 2026 will unfold, holding out hope for pent-up buyer demand, but acknowledging no external pressures for prices to rise. Flat or continued downward pressure on prices is the most likely scenario. Beyond the numbers, several underlying factors are shaping this market. On a more positive note, Canada's mortgage arrears rate remains exceptionally low at 0.25%, holding flat from the previous month. This is a stark contrast to the USA's rate of 1.61% and reinforces the adage that Canadians pay their mortgages. The highest Canada ever saw was 0.65% in 1997. So even at its worst, we are far from the US situation. However, a significant inconvenient truth impacting British Columbia is the increasing difficulty for foreign investment. A recent BC Supreme Court ruling regarding the Prince Rupert Port Authority, where the Metlakatla First Nation successfully cleared a path to sue the port over an alleged export monopoly, creates a dangerous precedent. This legal minefield signals to foreign investors that even with Crown approval and billions in investment, projects can be stalled in courts for years. Markets despise uncertainty. And this BC risk, whether in housing or energy, sends a clear message that the rules of the game can change mid-match, causing big money to leave. As we've seen with housing starts, when investment dries up, everyday Canadians ultimately pay the price. Moreover, the Bank of Canada has chosen to hold interest rates at their current level, with expectations for them to remain stable unless the economy significantly worsens. This lack of change removes a potential catalyst for market movement. Compounding this, the rental market is also experiencing a downturn. Year-over-year rental rates in Vancouver have dropped by about 7.5%, with significant dips in Burnaby and Coquitlam. This decline, coupled with no expected increase in international students or temporary workers, means less pressure for tenants to transition into the for-sale market and very little incentive for landlords to invest in new properties. This market environment also brings market psychology to the forefront. We're seeing sellers faced with diminishing equity, questioning commission rates, looking for ways to net more. However, in a market this challenging, the slowest in 25 to 26 years, with the longest selling times in 6 years and more competition than in 12 years, the difference between selling and not selling often comes down to working with experienced professionals. Choosing a discount service in such a volatile climate is akin to choosing a discount airline to fly through the worst storm in aviation history. When visibility drops, crosswinds kick up, and system lights flash, you want the best pilot with the best judgment, pattern recognition, and ability to land the plane. Fees aren't just about payment. They're about deploying the right systems, marketing, work ethic, and market knowledge to navigate a difficult situation and maximize your outcome. Pricing errors in a 9% sales to active market don't get corrected, they get punished, making accuracy paramount. Finally, it's crucial to understand that this housing downturn is not a contained problem. It has profound economic costs. Housing in Canada is not just an asset class, it's a tax engine, an employment engine, and a credit engine. When prices fall and transactions slow, government revenues decrease, less property transfer tax, less GST on new construction, fewer permits. This, in turn, slows construction, halts projects, and leads to job losses, creating future housing shortages. As lending tightens and housing, the collateral behind much of Canada's debt, loses value, risk rises, credit contracts, and overall economic activity will slow. The housing downturn won't just stay in housing, it will spill into spending, employment, and government finances, a compounding effect that we must not underestimate. In summary, the Greater Vancouver real estate market in 2026 has definitively entered a new normal. We're facing historically low sales volumes, record high inventory, and consistent price declines across all property types, particularly for detached homes. The sales to active ratio is at a 13-year low, signaling a severely challenged market where buyers are cautious despite favorable conditions. While Canadian mortgage arrears remain low, broader economic uncertainties, including challenges to foreign investment in BC and stable interest rates, are contributing to this stagnant environment. The rental market is also softening, further reducing buyer urgency. This is a complex buyer-favored market, yet one where transactions are scarce, underscoring the critical need for expert guidance to navigate these treacherous waters. If you are contemplating selling your property in this challenging landscape, or if you are a buyer looking to understand how to leverage these unique market conditions, remember that true expertise is more valuable now than ever. Don't step over dollars to pick up dimes. Partnering with professionals who have the experience, market knowledge, and dedication to fight for your best outcome can make all the difference. For a personalized strategy to buy or sell your home in this evolving market, don't hesitate. Call or text me today. Let's work together to achieve your real estate goals in 2026.